Let's talk commodities now and what's likely to move us today. Jonathan Barratt from Commodity Broking Services in our Sydney bureau for us. Jonathan, it was interesting to see how the US dollar did spike a little bit and take a wind out of the sails of the oil price.
Yeah, Carson, it really did. I mean, that seems to be one of the focuses at the moment where we are looking at the US dollar, or the potential strength for that US dollar as a risk aversion. If a lot of the viewers look at the dollar index, they can start to see that perhaps that dollar is looking a little bit better bid. That might also take the Aussie under a little bit of pressure as well. But I think it'll be quite interesting to focus on how that Greek situation evolves.
Yeah, I mean, in terms of data releases, that aside, it's not as if there are that many fundamentals that are pointing to any big moves in the commodity price for oil.
Look, for oil at the moment, they're not. We're at this really interesting situation where we've had a stream of inventory data that has a trend for increasing, and it's a concern when that inventories build, but we don't get that follow through in demand. And then when economies start to withdraw, or governments start to withdraw their stimulus packages, you start to think where that demand will come from. And I think one of the big things that we're focusing on at the moment is how the inflation, particularly in those emerging economies, China, and particularly India, where they just moved on their interest rates, will eventually affect the demand for commodities for those economies. And when you combine the two of them, you can start to get a picture for commodities that perhaps is not all that bullish.
Well, that's interesting, because whenever you have cooling, it implies that heating, if anything, has triggered that. Now, it seems hard to believe that a mere move in interest rates is going to scotch growth prospects in those two big economies. Is it that simplistic?
Yeah, I think it is, but I think the key you've got to look at, or the focus, is not whether or not these economies are going to slow. It's the fact that they're going to not grow as fast. Now, it'll be the perception that the investors and the traders feel that will occur, not what will actually occur. Because we actually see growth might go from sort of 8-9%, it won't go to 12-13% in the case of China. It just might stay at 8%, which is still a very, very healthy economy and still require a lot of demand. But I think it's that lead up to that analysis that a lot of traders are going to focus on, and that might hurt the demand for commodities, or the prices for commodities. And I think that's the one we've got to really focus on.
So where are they putting their money, Jonathan, when they make these moves and they believe they're not going to get their 12% month on month? What do?
Carson, I reckon that they basically just put them in the bank because it'll be that hot money that'll move around the economies. It'll be, shares. It'll be sort of cash. People will try and sort of move into some of that commodity space. We're still seeing a lot of interest, particularly, in the resource sector in Australia, because there's a lot of M&A activity. And I think that's where a lot of money will focus into those resources that are certainly headlined. Iron ore prices very strong. Gas from coal very strong. All these sorts of commodities at the moment, I think, is where some of that hot money will move to.
We saw copper off about 0.7%. Gold was not immune either. Just in terms of the dollar influence, where do you see that heading this week? What are going to be the key drivers underpinning further US dollar support?
Look, I think, let's put it this way. I think if we get more of a spin-off out of what's happening in Greece, then there is that contagion, or that potential for that contagion to develop again, then you will see people move to the US dollar just as that risk aversion trade. And I think if that is the case, then that's going to sort of hit a lot of the commodities just purely because of that correlation with the US dollar. So we're going to be focused a lot on what's happening in Europe, also a lot on what's happening particularly in the UK with the pound. Obviously the pound's sort of been very volatile, and if we get people move into the US dollar, it'll trickle through to some of the commodity prices, and then we might see a bit of a down week for some of them.
All right, what did you make of that statement from the Bank of England on inflation, and the idea that, if anything, it was likely to fall to below the 2% target?
Look, I think that's the right thing. I mean, if you look at the numbers, and this is the interesting thing, because comparing those economies that have stimulus packages to those economies that don't have stimulus packages, who have inflation, bringing the two together, we had some pretty benign data out of the US during last week, and we've got the same sorts of benign sets of inflation data out of the UK. What it does tell me is these economies aren't really moving. You've got no one seeking prices. So you've got that effect where the stimulus packages, if they withdraw, are really not going to stimulate these economies. Yeah. So having an inflation target which is low, in my mind, is perhaps not the best thing at all. And keeping interest rates at these levels and lower are certainly not stimulating the economies.